This is eSec Money and Insights. Let's get over to our episode. Hi, guys. How
Hello,
are you?
Brooke. Yeah,
Hey,
good.
Hello,
Brooke.
Newman.
Hello. Yeah, we're good. We're good. Nice and busy.
All right.
Or it seems that way
Uh,
anyway. Mark's busier than I am.
I'm pretty eager to podcast today, so I'm trying to decide whether I'm supposed to play it cool and wait a bit to tell you what I'm excited about, or if I can jump right in.
We're already podcasting. When you make us show up, that's a podcast. You hit record right out of the gate. Let's do it. What are you
All right.
excited about?
I'm excited about a new idea that I had. I'm an avid podcast listener myself. I do listen to ours quite a bit, but
Hmm.
I listen to others as well. I might be our number one fan. I had an idea to have more listener engagement by soliciting questions from our listening base. Jim, I shared that idea with you a few weeks ago. You told me good luck trying to get people to actually submit questions to us. But with very little effort and very little attempt thus far, this is my official plea and rollout to the market and to our listeners. We've already received a question, and I wanted to kick it off and give you the question that came in from one of our listeners.
So you being a
And
listener,
it's
did the
not me.
question
It's
come?
not me. It's not my own
Time
question.
out. Does this person work for you?
Yeah.
No, in fairness, I have no clue who the person is because we sought legal counsel before doing so, and
Yep.
we're told that we should not be attributed to anyone, and therefore we're not asking anyone's name. So, first of all, listeners, we would welcome your questions. If you have a question, you can go to our website. On our insights page, there is a place to submit a question. We won't ask you for your name or your affiliation, just the question. Submit it. You can ask anything you want. If we see things that are totally inappropriate, we'll save those for when we're not recording. Otherwise, we'll be happy to share and weave them into our podcast episodes as it makes sense. My theory is I'm always going to surprise you guys with whatever the question is, which is how I like to play things. So,
Great.
yeah.
Awesome. I
All
like
right.
surprises.
Normally, I feel like we should end with the question, but because I'm pretty excited about this, I was proposing to start with the question and then go into our normal chit chatter.
All right. I second that motion. I don't want to derail your giddiness.
Yep. Nope. I do not want to keep you waiting. Let's go.
All right. I've been waiting for 3 days. It's been hard to not pre share the question. It's not that exciting of a question, but I think it's a very relevant one, which is as the industry continues to see an increase in new vendors coming to the market offering alternative trading solutions to the legacy platforms, do we think we will eventually see consolidation of vendors, or is each service offering sufficiently differentiated to be able to operate on a standalone basis? So that's the question. I think we should not be specific about one offering versus another, but I think we can talk about it on a generic basis in terms of how the market is positioned. And we've had these conversations ourselves, which is there's so many solutions out there right now. And depending upon conversations with counterparts and who's on what, you're trying to match people in a lot of different venues and meet them. It's like dating a lot of people at once. You have to go to many locations to date people these days.
Do you have experience dating many people at once?
I don't know how I can even relate to that.
Me
That's
neither. It's a good question. We do grapple with it internally because it can get expensive
Yeah.
from allocating resources or even a cost perspective to be on every platform if there are 10 or 15 of them. But I would expect consolidation. Each platform that we look at is a slightly different mousetrap. It would make sense to see a consolidation of synergistic companies if they had one platform with a strength and a weakness that matched nicely with the opposite in another platform that they would consolidate. But there's room for plenty. So long as you have an internal system that's built properly, there's room for plenty of distribution platforms. Disrupting all of that might be the concept of standardized messaging. The market's looking at fix at the moment.
Yeah.
And then so in that instance, do you need all the platforms? It really depends on your model. At eSec, we would like to adopt as many as we can because they're just different venues for distributing from our perspective, different end users. But do you agree or disagree with that, Mark? I know you look at it closely and have thoughts on it.
Yeah, I generally agree with everything you said and think fix should be part of the conversation too. What I'm more certain about, as opposed to consolidation and what things might look like in 5 years, is that competition breeds innovation, whether it's securities lending or anything else. Having multiple offerings is great for the industry. It will bring us better message types to market quicker. It obviously could have an impact on pricing. There'll be copycatting, right? Instead of one firm maybe being the center for ideas, if there's five firms doing development at the same time, we know people will copycat pretty quickly when someone has a good idea. I think overall, when you consider the types of technology solutions available in other marketplaces and in capital markets in general, the idea of having five different ramps is good. It will move things along more quickly from an innovation and automation standpoint in the next 5 years. I feel more certain about that than the who, the what part of the equation.
Do you think that it bifurcates liquidity to have a lot of different platforms, or do you think that doesn't matter ultimately?
If you think about the way we do business, yes, it does bifurcate
Uh,
inventory, or it would in our instance. But that's only if you're thinking about the world, how we do business today, and just applying it to the technology available and tomorrow's world. So, meaning we trade on a bilateral basis. We call XYZ broker. Here's our longs. Okay, I can take these. He says, here are my needs. Okay, I can fill these. Bilateral touching of counterparts. And so in the new world, if one of these platforms has an offering that is more than just that, if it's some sort of matching engine or an exchange of sorts, it's going to look a little bit different than the cash markets, but you can conceive of different value that somebody could bring to the table other than just connecting bilateral relationships in an automated way. Opens up a whole new world. I think that's where we'll get. It'll take a while. In the short run, yes, it bifurcates. We'd have to pick platform A to do our corporate bonds on and platform B to do our US equities on, break it up by client, or somehow bifurcate that inventory such that we don't dupe trading on two different platforms at once. But I think when we think about the business a little bit differently, it'll work. So it's just a matter of how many platforms and who's left standing type thing.
And Mark, you talked about the copycat effect a moment ago. Don't you get the sense, at least this is my interpretation of the market participants that are offering solutions out there, is that while even if they have had a specialization in a certain area, they're all expanding and growing the offerings such that a lot of them are ultimately competing more directly and head to head, expanding what they're doing and the types of trades that they're supporting. I think they're all ultimately trying to compete to be that number one, number two venue ultimately, or survive the others. It felt like you could have put them all in their own unique box of how
Yep.
you would go about using them. I think that has evolved and changed rapidly in the last year or less. Is that a fair understanding on my part?
It absolutely is. And it makes sense too, because if you look at these vendors or these different marketplaces, you want to be able to scale in every vertical by market asset class and by the participant type. Some vendors might service broker to broker hard to borrows and ETFs more than traditional agent lender flow. You want to be able to, as both a vendor and a participant, scale wherever you want to. It makes total sense that if you're a specialist in one place, you would apply that technology or a solution somewhere else to scale the other vertical. I see a ton of value in it. That doesn't mean you can scale with everyone simultaneously, which I think goes back to your original question. There's a lot of participants, whether it's beneficial owners, dealers, agent lenders, third party lenders, custody banks. You can look at who contributes to the pie in a lot of different ways. And different people are going to need to plug into different vendors for various reasons. And then some will want to scale with each of them in different verticals. Others might want to choose just a vendor or two. So I think it totally makes sense for them to broaden their product offerings and try to be a little bit less specialized without giving up whatever was that original mousetrap. But yeah, that's what we're seeing. We're receiving inbound sales offerings from vendors that traditionally maybe were thought to service one asset class or one region or one market. Go back to, you always think of it as a product, but there's also the region and the participant type. There's been platforms that I traditionally viewed as broker to broker that are pushing hard for agent lender, traditional agent lender participation. When I have conversations with borrowers, the thing that we always grapple with is critical mass. It's okay, it's classic chicken egg. You need critical mass. So is it demand first? Is it supply first? How does that scale in conjunction? So there does need to be a bit of groupthink. I think that's probably where the industry is struggling the most, is that collective groupthink,
Mhm.
aligning timelines and resources then to meet each other.
Yeah, we got a lot of thinkers.
Not on this call, we don't.
I was gonna say, not this call.
Well, that's why
Welcome
Mike
back,
joined us.
Brooksy.
Yeah, we're happy to
Yeah.
have you, Mike.
Always
He's
working.
he was pulling
Yeah.
that important trader gig where, oh, I gotta go, I gotta pick this up, and he
Yeah.
hangs up and then comes back 5 minutes. I've used that before.
Yeah.
You see right through it. You went and got a sandwich. I was interested in getting your view on, because I did see something. I've been doing off-desk stuff the last couple of days, but I noticed that the expectation in the market now is pushed out another month for rate cut, right? I don't have
Yeah.
that incorrect, but
There's been a
then
lot of
you
speculation
see
there.
this pretty good sized rally in the 10-year. Is that the way
It's
to
a
think about things? If the rate cuts get pushed out, the 10 years going to rally?
it's a bit conflicting. You would have thought some of the economic data yesterday, at least in the kind of better than expected payrolls number, lower unemployment rate tends to be all positive for the economy, and maybe think you can push the rate cuts further back into the back half of the year because the economy does not need the support. Part of the rally in the bonds is the market's focusing a little bit more on some of the weaker retail sales information, looking at the consumer really showing a slowdown in overall spending. The market was overheating. Valuations on the equity front are pretty prominent. So it was pretty optimistic from an investor standpoint. So I think some of that consumer spending and retail data maybe put more pessimism into the market. And when that happens, you see more of a flight to quality, right? So you're seeing people really heavily get into reevaluate, reallocate into bonds. So I think that was the knee jerk reaction. It is a tough market to navigate because you get a continuous calendar of economic data, and a lot of it is in contradiction. You try to eliminate the noise and see what the Fed's thinking, and that's a Fed that's going to change in a couple of months as well. I think market consensus, or at least maybe not consensus, but base case at this point is that we have seen the last of a Fed move from the Powell administration. And then once the new administration gets in, it's a Trump administration appointee. You have to imagine that some of the hawkish moves maybe you've seen this week will have more of a dovish sentiment. It's hard to wrap the head around, but translating all the macro stuff back into sec lending, we've had a good start to the year from a treasury demand perspective. Part of that is clean balance sheets from our borrowers. Fourth quarter, we always grind through. People are looking to turn away trades, deploy balance sheet in an optimal way. We've added trades back in open term structures at favorable levels. A lot of maturities resetting lower. That's always the plan. There's some Fed technical factors of different programs and facilities, buying bills, the Fed being able to fund treasuries at a fixed level, stopping the quantitative tightening. And I think that was December now at this point. So there are some technical factors that are making reserves more ample as well. That tends to help our market. I do think that flight to quality narrative, we're seeing that kind of play out in our market to start the year. I hope in some of the volatility on the cash curve and treasuries will maybe get some opportunities in the specials market that's been fairly quiet. Bills, short coops, some of the on the runs hopefully can pick up demand here as well.
I'm happy to hear the flight to quality trade still exists. We're leaning to a country that's got a super weak dollar, runaway federal debt, polarizing leader. It's good. Yeah, flight to quality. I like it. Mark, I have a question because now Brooke apparently takes questions on our podcast and take up a lot of time. So we got a rapid fire to stay in our kind of plus or minus 20-minute window.
By the way, hold on.
Come
I'm
on.
gonna make it longer. No, I just want to tell you that long form podcasts, which I know we are not one of those, and I'm sure our listeners would agree that they would prefer us to stay short and concise and snappy. But long form podcasts are like a thing and a great way that people get information these days. So I just want you to know that it's a real trend that adds value. We might need to add more actual value in what we're sharing with our listeners in order to allow them to endure a long form version of our podcast.
Jimmy out on long form Joe Rogan style podcasts, right?
I was gonna say, I think Brooke just like mansplained, the reverse mansplained Joe Rogan to us, or like the Call Her Daddy podcast. Like, are we under some rock?
No, I just let her go, Mark. No reason to call her out on it. Then she starts laughing.
Yeah.
Then the snorts happen. It's just not worth it. Mark, Brooke and I sit on a committee that meets this morning. And so I talked about it a little bit when I gave the equity market update and I made stuff up. Hopefully the guy who runs the meeting doesn't listen to our podcast. I doubt he does. It got me thinking about it. And I was looking at the VIX. Today's the 12th of February, and the VIX is around 17 or so, but the market feels a lot more volatile. I bet you'd probably agree, Mark, but it's really kind of sector by sector. And if you look at what's going on in software today, and I've read a few articles that confirmed what we're seeing, which is just a huge price movement And then it's not just long selling, it's short selling too. Even names like Microsoft, you can see the amount on loan borrowed today is much greater. I just wonder, one, what are you seeing there? And two, if the software sector and broadly say AI and anything that's going to be disrupted by AI is also under pressure, and many of those stocks and companies have mid and large cap equity in the market. Are you seeing it easier to raise cash because of the shorts in that space? Meaning, is GC coming easy to you? X any of the GSIB conversations, the other stuff we've touched on as to why you might get cash versus non-cash, but just purely core shorts. What are you seeing in those sorts of names? And is there a relation between the new shorts we're seeing in kind of large cap technology specific sectors and your ability to get loans out to raise cash for clients who look to do that sort of biz?
Great question. It doesn't sound like you made anything up. So, yeah, software is most net sold sector this year. We are definitely seeing a ton of borrows in software. When we think about main index equities and large cap, like you mentioned, low beta typically doesn't trip up VAR models, but we have so much software on loan right now that my risk manager pointed out to me this morning that the software sector borrows have caused a bit of a blip in some of our bar calcs. That tells us two things. One, what we already knew, software is net sold. We have a ton on loan. Two, it's behaving like a high beta mid or small cap now. And that corresponds to your comments about the VIX. It touched 20 a couple of weeks ago. We've been in this quasi elevated state, nothing crazy, but markets have been more volatile, not a shock to anyone. And then how has that pertained to GC lending, right? So we'll talk about E4E and cash in the same breath. Loan balances have been really healthy through the start of the year. What we said in a previous podcast was Q4 this year, we saw higher volumes through December than we did the prior year. The first week of January, we saw maybe a slight retreat in demand to borrow and just overall GC funding, but it snapped back pretty quick. What we're seeing right now is no restraints on the loan side for maintaining balances and then opportunities to even add balance in some spots. I had a counterparty come to me today trying to place 500 million through the long weekend. So I think what we're seeing is there's definitely pockets of opportunities to increase GC lending. As far as the cash trade goes, it's in a really healthy spot, and we haven't had to fight any headwinds so far.
Good. Yeah, that's what I thought.
Can I summarize my understanding of that? So all of that's good, and that's good news for the types of programs that we support for our client base and what to expect in 2026 and success there. So you're basically saying that has a lot to do with underlying borrows and price volatility on certain large cap securities that are being impacted by AI, et cetera. But it also combined with my understanding is that large GSIBs have had some regulatory relief on their balance sheet constraints. Are the two things hitting in tandem and both helping that pop, or do you really see it more as one or the other? Am I
Yeah,
right in
you
summarizing
are.
that?
Yeah. No, I see both those as contributing to what feels like a really healthy market that's going to
Yeah.
generate some
Yep.
revenue for our clients on top of what we're hearing from most. Mark and I have been doing 2026 expectation conversations with our counterparts, and many of them expect 2026 to be a good year, and many are reporting a gross positioning up in a balanced way, skewed long, but in a more balanced, healthy way, coupled with the 2 points you just brought up, Brooke, sets us up pretty nicely. We're already seeing it. January was a nice month for our clients, and February is already on the way. Feel pretty good about current run rates for us.
Aren't we in February? Smack dab in the middle. It's not like on the way. Like we're
I, w-
here.
I would
We're
argue halfway through.
Yeah. Like it's going to be Valentine's Day in what, two
probably
days?
your is that your favorite holiday,
No, it's
Miss
really not my
Hallmark?
favorite holiday.
So this is how I can reverse engineer what I think I see from the demand side and just kind of gross flows sometimes. So Mike, we saw an increase in both overall demand and slight widening of levels at Jan month end, which is CAD quarter end.
Yep.
So, in markets where this is right before some of the recent volatility kicked in, markets were at new highs. We had a month end and a quarter end, and we saw decent uptick in demand going into that month end for synthetic and for repo secured funding. So that tells me that dealers are extending sheet or their sheets are extended and that balances are really healthy. And that's just how I tend to try and reverse engineer it at times. Like when you see people coming in for those trades, it tells you there's a clear conclusion to make. Mike, what do you think?
I think that's right. Asset valuations are probably the biggest driver of a lot
Yep.
of this. The synthetic and swap spreads are just parallel with that as well. I do think part of it is also, what was it, 2, 3 years, we've really seen the year-end trade and demand really pick up. And then unfortunately, that time of year, there's not as much cash or HQLA easily turned into US dollars around that time. I feel like dealers are more locking in trades at maybe better levels now to get trades on. And a lot of these trades are sticky, right? It's the nature of the structure of them. They're extendables, they're evergreens for the most part. So I do think the more funding people can lock in now, it only puts them in a better place in the fourth quarter when they're really stretched long, especially if the view for 2026, which I believe it is equity markets are going to be higher this time in February than they are today. I think most people will probably concede to that. And I mentioned like the Fed coming in, and to get a Fed being a dovish tone, markets like that, there's more, in theory, lower interest rates, more money to deploy in other asset classes. So I think that's part of it. I think last year's Liberation Day, when markets took a quick spike and people were looking to unwind some of these trades, or at least having the conversations. The reason those books held in was people get nervous around the elasticity of those trades, right? Meaning if you take them off, it's going to get replaced away, right? You're not just holding the cash. Cash is finite in this market. When markets inevitably went right back up to their all-time highs a very short period later and their books swapped, they're looking for funding again, that funding is gone. So I think, it's more people looking more of what are others doing? What are you hearing from the street rather than let's re-rate that or let's put in a call period. So I think that was a good exercise for how people are approaching this year as well. So I do think we're seeing, particularly in equity funding, that demand is going to be there. I don't think that's going away. You're seeing some kind of structured product in other fixed income assets. CLOs is a big buzzword now that has come to market. I think more investors are looking at taking the high quality tranches, AAA and better syndicate loans in mid market. And also, I think there's more issuance and dealers have more clients that are long it or need to finance more. So I think it's a factor of 2 points. And there's some pretty natural and I would say attractive spreads in a lot of these trades that fits sec lending portfolios nicely.
I have a question. We're all over the map today.
You should submit it via our website.
Oh, I cannot believe you just did that to me.
Have we
And
started the website questions yet?
well, no, not really. But Brooke
Uh,
pretended to have gotten an anonymous one, and I know she knows who sent that in.
I
And if
asked,
it might have been her sister or, somebody she prompted to
could
do
have
it.
been Katie. Could have
It's
been
a
Katie.
could have been Katie. I'm just curious what Mark McNeil thinks or others if you follow the crypto world, but Mark does it as a hobby and it's less related to securities lending at the moment until we start getting asked to take crypto and or crypto ETFs as collateral. But Mark, what's your take on Bitcoin at 65 and XRP? Everything's cut in half basically from its highs back in October. What's your take on it? Is there permanent damage being done to crypto as a usable product in the market, or is this just a little bit of a relief here and then it'll go back on track and start headed higher?
I think what's different this time from prior bear markets is that there's a lot more institutional involvement and there's more TradFi products that are available to retail as opposed to just the outright buying of Bitcoin on one of the crypto native platforms. Bitcoin in crypto peak to trough has done these 50 to 80% declines a number of times. Bitcoin tends to fall 4 year cycles. We're in year four where it would pull back. We're down like 50% right now, which if someone had lived through all these cycles over the past 10 or 15 years, they would tell you this is one of the more shallow bear markets. So I think what's different though is the nominal delta is way bigger because we're talking about $60,000. That's a lot. And then the other part is the institutional involvement. When you look at the top holders of IBIT in some of these TradFi products, it tends to be hedge funds and big players in markets in general. I guess I don't really have a firm outlook on where I think it would go, but it's just like history rhymes. This has happened before, and it's almost like when you look at some high beta stocks like Amazon in its early days, a lot of these types of assets or securities tend to have these massive pullbacks. So We're in it now, obviously.
Are you seeing a lot of shorts on MSTR or coin?
We got pretty persistent demand for MicroStrategy.
Interesting.
Yeah. I'm not sure if it's outright shorting or market making or what. Supply can be somewhat limited in those. Obviously, we have demand to borrow all those crypto treasury companies. A lot of those are way down because they trade up multiples of whatever they're holding. Some of those are down beyond 50%. A lot of them were IPOs or companies that pivoted. As a strategy, we see persistent borrowing of all of those. And those tend to be more mid cap, small cap. Strategy aside, which is obviously large cap.
Yep. Cool. Thank you.
Then we had, BitGo was an IPO this year too. So I think what the impact might have in our market is, are there more crypto treasury companies? Maybe that kind of goes by the wayside. Was it a retail phenomenon like SPACs were? Or maybe they persist. And then if this is going to be a growing sector, what happens to companies that plan to IPO? So we had Circle, BitGo, obviously Coinbase a few years ago, and many others. Are the other companies waiting in the wings going to wait until sentiment changes? Does sentiment change in a year? Does it take that long? The crypto pipeline's been relatively hot the last couple of years. So if anything, it probably puts a dent in that in the short run.
Yep. Thank you. I just can't really understand it.
Are you asking Mark just because he falls into a different generational bucket?
Yes. Thank you for pointing that out on a podcast listened to by many thousands.
Yeah. We have
Are
a great
you,
listening base.
Michael?
They're all eager to ask a question as well.
Wait, you just mentioned how you're a listener, Brooke, and now I'm starting to question our statistics. You travel quite a bit. Have you listened to our podcast in 15 different countries? And that's how we pad the stats at the end of the year with our.
Am I padding it out with my global travel? I don't think that I am swaying our numbers enough, Jim.
Okay, good. Just making sure.
I think that there's some real connection that we have.
Good.
Speaking of travel, we've been doing a lot of it. We have a lot of it upcoming. I think our biggest challenge actually is to get another podcast in and amongst upcoming travel. So we will try hard, listeners, to do that effectively, or we'll just do it without Jim because he's often the problem. Right, Mark? Mike?
I've heard that my whole life.
All I know is I accept a lot of the invites and then it gets moved a lot. And they're like, what do you mean you can't join that day? I'm like, well, I joined the first 6 of them.
Brooksy, don't pretend you don't call me on the side and say, hey, can you cancel? Jim, please call Brooke and tell her we need to move the date.
Oh, so you're just the one that can stand up to me then, huh?
Yes. Yeah.
Thank you for your service,
It's
Jim.
called
Very brave. Very brave.
It's groupthink. It's consensus.
March is going to be tough, but we should try and get it in. You and I are both at PASLA. We could do a podcast on site in Thailand if we can find a time that works for these guys and then get an update on what's happening here.
Does that mean that we do it middle of the night?
Do it with someone there.
Somebody at the conference?
Brooke can rent a studio.
In living color?
Yes.
She could pack her microphone.
Then you can tick the Thailand box for your 2026 statistics.
It's a good idea, Mark. I like it. We'll have to give it some thought.
All right. Done and done.
Excellent.
Jim, are you going to find the person to join us to pod?
I absolutely
or do you
will.
Want me to actually do that?
I'll identify and then you can actually rope them in. You're very persuasive when it comes to getting people to podcasts. Perfect.
All right, listeners, thank you again for joining us. As always, I am serious. If you have any questions on the market, on our podcast, on Jim's hair products or otherwise, please don't hesitate to reach out. You can go to our website at eseclending.com. There's a link to submit a question for the eSec Lending Insights podcast. We're excited and we will share them over time. We'll sprinkle them in as we receive them.
Thank you, everybody.
Bye, everyone.
Bye, folks. Thanks for listening. And now for our disclaimer.
This material is for your private information and does not constitute legal, tax, or investment advice. There is no representation or warranty as to the current accuracy of, nor liability for, decisions based on such information.